There's a specific kind of blindness that happens when we look at infrastructure. We see the big stuff, right? The airport terminal, the glossy glass facade, the solar farm stretching out to the horizon. But we never really think about the skeleton.
The skeleton.
Yeah, the veins, the arteries, all the stuff that actually holds the structure up or, moves resources around inside the walls. I'm talking about pipes. It sounds boring.
It sounds incredibly boring. In fact, if you mention steel pipes at a dinner party, I'm pretty sure half the room would suddenly need a refill.
Exactly. But if you look at the data we have today, specifically for a company called High-Tech Pipes, boring is where the money seems to be hiding, or at least that's the theory. We're looking at a company that's sitting at this really weird crossroads of record-breaking sales and somehow falling profits.
It is a fascinating case study. We're looking at a fresh stack of reports today, February 10th, 2026. We've got analysis from Mirae Asset Sharekhan and SBI Securities, both reacting to the company's Q3 FY26 results. And honestly, reacting is putting it mildly. These analysts are seeing something in the numbers that, well, the casual observer would miss completely.
It's a bit of a head-scratcher, isn't it? I was reading through the headline numbers before we started, and it felt like I was looking at two different companies.
You're talking about the divergence, the top line versus the bottom line.
Precisely. On one hand, you have this massive revenue explosion. They've crossed, 1,000 crore in a single quarter for the first time. Revenue's up 40%. I mean, that's tech company growth. But then you look at the profit, and it's actually down.
It's the classic profitless growth scenario, or at least that's what it looks like on the surface.
So that's our mission today. We need to figure out how a company grows sales by 40% but makes less money. And crucially, why these analysts, who are usually pretty ruthless, are looking at this mess and saying, buy. Sharekhan is predicting an upside of over 80%.
Which is aggressive.
Incredibly aggressive. So help us unpack this. Is this a company in trouble, or is this a coiled spring? Let's start with the crime scene, the Q3 numbers.
Crime scene is a bit dramatic, but let's go with it. The headline figure is undeniable. Revenue came in at 1,069.6 crore. That's a 40.5% jump year on year. And it's important to note this wasn't just, price hikes. They actually moved more metal.
Right, because sometimes you see revenue go up just because the commodity price spiked, but the business itself isn't actually growing.
Exactly. But in this case, sales volume, the actual weight of pipes sold, was about 1.36 lakh tons. That's up roughly 10% from last year. So from a demand perspective, the factory floor is busy.
Okay, so the growth part of the equation is real. They're selling more pipes, but then we get to the profitless part. The profit after tax, the PAT, dropped 9% to 17.4 crore. Where did the money go?
Well, it wasn't an accounting error. It was a perfect storm of three factors. First, and this is the big one, finance costs.
The interest on their debt.
Yes. Their interest expenses shot up by nearly 40%, 39.7% to be precise.
Wow. That is a massive hike. Is that just high interest rates, or did they take on a lot of new debt?
It's mostly the latter, which connects to their expansion strategy, and we'll definitely get to that. But essentially, they borrowed heavily to build new capacity. That bill is coming due now.
So they're paying the mortgage on a mansion they haven't fully
moved into yet. That's a great way to put it. It's a timing mismatch. Then you have culprit number 2, which is a bit more technical, the commodity cycle. Steel prices, specifically hot-rolled coil, or HRC, took a dive during the quarter. They fell by about 2,000 rupees per ton.
Now, hang on. Explain this for me. Shouldn't cheaper raw materials be a good thing? If my ingredients cost less, my burger should be more profitable, right?
In the long run, yes. But in the short run, it's an inventory nightmare. Imagine you bought a warehouse full of steel 3 months ago when the price was high. You have to hold that inventory.
Okay, so I'm sitting on expensive steel.
Right. But today, the market price for steel drops. The price you can sell your finished pipes for is usually linked to the current steel price. So you're selling pipes at today's lower prices, but you made them using yesterday's expensive steel.
Inventory loss. You get squeezed in the middle.
Precisely. It just eats your margin alive for a quarter or two. And then the third factor was just standard depreciation. You build new factories, your depreciation charge goes up. That rose about 6.6%.
Okay, so high interest, a bad swing in steel prices, higher depreciation. That explains the ugly bottom line. But usually, analysts punish a company for that. Why are Sharekhan and SBI Securities looking past this?
Because they aren't looking at Q3 as a steady state. They're looking at it as a transition. They see a company that is fundamentally changing what it sells. And that brings us to the value-added strategy.
I saw this term all over the reports, value-added products, or VAP. It sounds like corporate buzzword bingo. What does it actually mean for a steel pipe?
It's the difference between a commodity and a specialized component. A standard steel pipe, a general product, is basic. Round, hollow, steel, everyone makes it. Margins are razor thin.
A race to the bottom on price.
Exactly. The EBITDA margin on those is maybe 2,500 to 3,000 rupees per ton. That's your baseline.
Got it.
Now, value-added products. These are things like galvanized pipes treated with zinc to resist rust, or color-coded sheets for roofing, or cold-rolled products for precision engineering.
So you're doing more to the steel before it leaves the factory.
You're processing it, and because you add that utility, the customer pays a premium. The EBITDA on these products is 4,500 to 5,000 rupees per ton.
Whoa, that's almost double the profit per ton.
Yes. And the strategy isn't just make more pipes, it's make more of these pipes. Right now, VAP is about 38% of their sales. The target is 43% by the end of this fiscal year and 50% by FY27.
So in about 18 months, they want half their business to be this high margin stuff.
Correct. And that changes the entire economic model. It's a buffer. Even if steel prices fluctuate like they did, that extra margin protects you. In fact, that's one reason their revenue grew so much, even when steel prices were down.
Okay, that makes sense. You pivot to quality. It's like a coffee shop ditching the drip coffee to only sell lattes. But you can't just wish for those sales. You need the capacity. And reading the SBI report, the scale of what they're building is, frankly, a bit scary.
It's ambitious. We're calling it the capacity moonshot. Just recently, high-tech pipes crossed a major milestone, 1 million tons per annum of capacity, 1 MTPA.
Puts them in the big leagues.
It does, but they're not stopping. The plan is to double that to 2 million tons by mid-FY29.
Wait, hold on. It took them decades to get to 1 million, and now they want to add another million in just 3 years. That feels reckless.
It's certainly aggressive, but they've earmarked between 500 and 600 crore for this. And the key thing is they've already spent about half of it.
Ah, so that explains the debt, the finance costs we talked about. The money's already out the door.
Exactly. They're in a massive capex cycle. They just commissioned the Sanand Unit Phase 2 in Gujarat and have new units in Jammu and Secunderabad coming online.
Why those spots? Is there geographic logic?
Oh, it's critical. Steel is heavy. Shipping it is expensive. You're basically shipping air inside a pipe. Sanand is near the ports for exports. Secunderabad and Jammu cover the north. It's all about minimizing logistics costs.
So they're building the factories, taking on the debt, but there's a huge risk, right? You build a 2 million ton capacity, you need 2 million tons of raw steel to feed it. What if the supply chain chokes?
That is the classic vulnerability. If you can't get hot rolled coil, you shut down.
So how do they solve for that?
Yeah. This is where the moat comes in. The reports highlight that high-tech has signed long-term MOTIS, Memorandums of Understanding, with the titans of the industry.
We're talking about the big boys.
The biggest. SAIL, Tata Steel, ArcelorMittal, NMDC, they have locked-in supply agreements.
So they basically skip the line.
In a way, it ensures volume security. Even if the market gets tight, high-tech has a contractual flow of raw material. It de-risks that whole expansion plan. It tells investors, don't worry, we can feed the beast.
Okay, so we've got the factories, the raw material, and the high-margin products. But we still need someone to actually buy 2 million tons of pipes. Who's the customer?
This is where the macro story of India becomes the tailwind. The demand is heavily government-based.
Right. In infrastructure, government policy is basically gravity. If they stop spending, the whole sector stops.
It is, and there are two big factors here. First, those falling steel prices that hurt them in Q3. The government actually stepped in. They imposed a 12% safeguard duty on steel imports.
Protectionism for the win.
For domestic players, absolutely. It reversed the price trend. Prices started recovering in Q4, so those inventory losses shouldn't repeat.
That stops the bleeding. But what drives growth? The reports mention the Jal Jeevan mission, the big water project, but it says demand was subdued. That sounds like a polite way of saying disappointing.
It was a soft patch in FY26, but management and the analysts expect a big revival in FY27. The money's been allocated in the budget, it just hasn't been spent. When those tenders open, it's a flood of demand for pipes.
Unintended.
Unintended, but appropriate. But look, even without that, look at the projects they supplied in Q3. It's a who's who of infra.
Give us the list. Where are these pipes going?
The new terminal at Benares Airport, Jaipur Airport, the Paruch Railway Station redevelopment, and huge solar parks.
See, that connects back to the intro. The solar parks need those mounting structures, which are steel tubes. The airports need massive roof trusses. Steel tubes.
Exactly.
Yeah.
And they're finally looking outside India, too.
Export.
Yes. It's tiny now, like 6% of volume, but they want to get that to 10% in the next few years. Europe is their biggest market.
Europe. That seems far.
Well, Europe's shutting down its own heavy industry because of energy costs. It's expensive to make steel there. That opens a door for Indian manufacturers.
All right, let's boil this down to the investment case. This is where the rubber meets the road. We have Sherakan with a target of 149, SBI with 121. At the time, the stock was trading around 80 or 85. Why so confident?
It comes down to two words: operating leverage.
Okay, I feel like that's a concept people nod at but don't really get. Break it down for me.
Okay, you own a factory. It costs you $1 million a year to keep the lights on and pay security, whether you make one pipe or 1,000.
Right.
That's your fixed cost.
Got it. The rent is due regardless.
Right. Now, high-tech just built all these new factories, so their fixed costs are high right now. But as they ramp up production, targeting 20 to 25% volume growth.
The electricity bill for the lights and the guards doesn't go up by 25%.
Exactly. The fixed costs stay relatively flat, so once you cover those costs, every extra pipe you sell is almost pure profit. That's operating leverage. When it kicks in, profits grow much, much faster than revenue.
A hockey stick effect. So Sharecan is betting on that hockey stick.
Yes. They're forecasting profit growth at a CAGR of over 36% through FY28.
36% compounded. That is hefty. But rockets can explode. What breaks this whole story?
Two things. One, steel prices crash again, deeper and for longer. The debt payments became very hard to manage.
And two,
Government spending. The whole expansion assumes India keeps building at this frantic pace if the government tightens its belt and cuts capex.
then high-tech has 2 million tons of capacity and no one to sell to.
And a lot of debt to service. That's the nightmare.
So to wrap this up, high-tech pipes is basically a bet on the Indian infrastructure story.
It is.
A company swallowing some bitter pills right now. High interest, inventory losses to build a massive engine for the future.
A transition story. From commodity to value added. From a small player to an industry giant.
And investors are being asked to trust that the transition pays off.
That's the bet.
Before we sign off, I want to leave you with one thought.
Yeah.
We talked about the capacity moonshot, doubling their size.
Go on.
The Jal Jeevan mission, that water project, is crucial to their demand forecast. But we know how government timelines work. They are famously flexible.
That's a diplomatic way to put it.
So here's the question. High-tech is spending 600 crore now. The interest is due now. If that demand revival in FY27 gets pushed to FY28 or FY29, can they survive that gap?
It's a race.
It is a race. They're laying the pipes before the water is turned on. Let's hope the tap works.
Indeed. It'll be a fascinating few quarters to watch.
That's it for this deep dive into high-tech pipes. Thanks for listening.